morning, ladies and gentlemen. Thanks for coming to listen to our story. This is our interim results for the 6 months to February 2015. Distribution up 8.2. Can you guys see? Our distribution is up 8.2% at 52.46 cents per unit. Market cap is up 33% from 4.2 billion to about 5.6 billion. Assets under management 12.4% up from 7 billion to about 7.8 billion, or just shy of 8 billion. Net property income 10.1%, 291 million. This is quite important because we've had no corporate activity during this period. We've had no acquisitions, so this is pure rental, repeatable income, which is quite important. Good, solid fundamentals coming through our portfolio. Cost to income ratio down 6.6% to 12.7% from 13.6%. Again, another very important ingredient for us. It shows the efficiency at which the team runs the operations and the cost containment in the team. Occupancy from 98% to 97.8%. So occupancy has trickled down a bit, but if you look, year-end last year, our occupancy was 97.6%. So effectively, this, because it's a comparable period to February last year, it actually is up to 97.8%. Gearing at 38%. We've always said we want to maintain our gearing below 40%, and as we go through corporate activities, acquisitions, etc., it does go up and down, but 38% is decent. That's about 8% up, or 7.9%. Our average cost of debt remaining at 8%. This is one of our properties in Joburg, 99 Market Street. I think in Joburg we've probably got the best portfolio, the swankiest buildings in town. Milestones during the past 6 months, not much to talk about. As I said, there was not much corporate activity. We completed the bridge on Blue Street on budget. Some of the tenants started trading. In January this year, we had that 565 million accelerated book build at 11.90. I think it's quite important to emphasize, and thanks for your support as investment community. We were 2.5 times oversubscribed. We're looking for 400 million, and the book opened at about 9:30 that morning. We closed at about 12:30. We had R1 billion already taken. So we just couldn't take more. So we scaled back everybody to 565 million. In February, we started a process to acquire the remaining linked units of Ascension through a scheme of arrangement. We've set out the circulars. The voting date is on the 22nd of May. I think in principle we have a good support. Once again, thanks to the investment community. The company structure, quite a very simple structure. We have 19 properties, and those properties sit under the direct portfolio within Rebosis. We've made that acquisition of the Ascension Asset Management company last year in January. So we continue to own 100%, and the 32% of Ascension. We've got 55% of the Bs and 9% of the As. And these two, once that scheme is consummated in May, June, that will disappear and be direct property. The team, key directors, Camille joined us on the 1st of December, took over Janice. I think we mentioned this at the last year-end results. Gary has been with us, Chief Investment. Vuyo, looking after corporate affairs, HR and legal. Amanda, Company Secretariat. And Nigel, recent appointment to operations, effective 1st of January. Major beneficial holders, as at the end of February. The PIC, or government employees, 16.4%. Stanlib, 9.2%. Coro, 9%. Amatolo, ourselves, 9.4%. Sanlam, 5.8, Old Mutual, 5.4, Dream Fair, which is the old Ntwese portfolio vendor, 5%, Investec, 4%, Eskom, 3.4, Nedbank, 2.8, and the balance, 30%. Major fund managers, PIC at 16.7, similar to their beneficial, Stanley at 11.7, Coro at 10.7, Investec at 6.8, Sanlam 5.9, Old Mutual 5.5, Catalyst at 3.5, Sesfikile 3.4, Miaho 2.7, Greenroad 2.5, and the rest of the investment community and private clients at 30%. This is our history of distribution growth. In 2011, you'll recall that we had a short period, because we listed on the 17th of May to the end of August. We had a distribution that was declared for those few months. And then we, following year, grew by 12% on that, on an annualized basis of that. And then we grew by 7.6%, grew by 8.1%. Currently, in this period, we're reporting 8.2%. We've given prospects forward. And we've revised our focus range from 6 to 8 to 8 to 10. We'll talk about it later. So we're looking at a much more better picture going forward to achieve a solid set of results. It's one of our properties, Sunny Park, as you guys know, in Pretoria. This is the extract of the distributable income statement. I suppose what's important here is the growth in the net property income of 10% at 290 million. The income from the Ascension acquisitions, the indirect property, if you want to call it that, bolstering our numbers. The net finance costs have gone up as well. There's a next slide after this that just explains this more in detail. Antecedent interest for the units that we issued during the period, and just one tranche after the period. And these number of linked units include 15, I'll call it 16, just shy of 16 million units issued post the period. So that's the 10% net property income. Net operating costs at 7.2%. It's quite important to note that your operating costs should never be above your rental income, because once you start having operating costs escalating above your rental income, you have a problem. Finance costs up 53%. Again, we had that 523, which was utilized to fund 16% of Ascension units, which we acquired from Delta, and the capex of Hemingways and Blood Street redevelopments. Borrowings gone up, shy of 3 billion rand, 2,997. Our facility is 3.1 billion. As you know, we have part of the facilities, floating facilities, which enabled us to deposit our cash that's accumulated over the months against those facilities, earning a high interest. And generally, that's the difference between the two. Average interest rate at 8%, gearing ratio, as we alluded to earlier. That gearing includes that 523 that we spoke about, which was utilized to buy the units of Ascension and the capex that we spent. Debt fixed at 74%. We've always said we want to keep our debt around the 75% fix, so that we're going through DMTN program at the moment we'll talk about. Average term of debt, 1.8 years. And the reason why this is shorter, because we've got 643 million rand expiring in May, which we had kept on that basis with RMB. We're busy with a program, a DMTN program, which will replace that, which will bring down our cost of debt, and we'll look at a different average term of debt once that is completed, because we are looking at some longer term dated debt. Balance sheet extracts. Again, just to re-emphasize, we're just shy of 8 billion with our assets, 7.8 billion, made up of the core underlying property of 7 billion, the 32% that we own in Ascension, 728 million, the Manco that we acquired for 150 million, It's now 149. Cash and cash equivalents, so we had a lot of cash in our pockets at the end of the year, 624 million rand in the bank. And that really was the cash that we raised on those units, that 565 million, together with some of the cash that we had. But perhaps just to expand, we'll talk about New Frontier later. As you guys know, we spent about 1.2 on New Frontier. That investment was about 30% geared, with about 350 odd million rand that was borrowed, and the balance of about 820 million rand was cash in hand that we had. So part of that was that 624. Interest-bearing borrowings shy of 3 billion. Again, this graph is quite nice because it just gives you a breakdown of direct property is at 89%, and indirect property, that's the Ascension effectively, 9.2%, and the main core of Ascension making up about 1.9%. That picture looks differently already. We have another indirect property, as you know, with New Frontier of about 14% currently. Upon consummation of the Ascension transaction in May, June, that picture changes to 100% direct property, and the New Frontier changes to 9% indirect property. Debt expiry profile. So we've got about 20% of the debt expiring. Debt in 2015 against the available facilities. Similarly, in 2016, facilities utilize about 40% of what's available, and that picture going forward. Interest rates hedges. As you know, 75% of the debt is fixed. How is it fixed? Interest rate caps on the 1.2 billion. We've been criticized on the caps before. What we did in December last year, so we had an exposure. That cap was priced at 7.5. So in fact, that column should be the actual cap, the band of the cap itself. So that cap was repriced and it's sitting at 7% effectively. So our exposure on the cap is 50 points effectively. So if you talk about exposure, I've got the exposure on the 25% of the book that's unhedged, plus there's a 5% on that 1.2 billion of 50 points, exposure from 6.5 to the actual cap. We're floating at 6.5 currently. Interest rate swaps on the 745 at 7.3%, and fixed debt of 272 at 9%. That's old historic debt, which is coming up. That's really what makes up the 2.2 billion of the unhedged book. Of the hedge book. I mentioned this, that we've got, we pride ourselves with these beautiful properties. This is really one of our outstanding buildings in the Joburg CBD, 124 Main Street. So our property portfolio, the direct property, which is the 90% of our properties, we keep mentioning the point, or making the point, if you look at the number of properties relative to value, very small number of properties, talks to what we emphasize all the time. We invest in dominant properties where it's hard for tenants to move out because we've invested a lot and we look after them. The only reason a tenant would move out from a large building would be if your lifts don't work, they're frustrated, they have to walk up, floors upon floors every morning. The kind of properties we have, they're very large, dominant. Similarly, the shopping centers are very large, they're dominant. We're going to talk about retail performance later. Performing very well when the cycles are hard, times are tough. The bigger centers tend to dominate and they perform better. So having said that, we've got 4 shopping centers, dominant shopping centers, 14 very large office blocks, and 1 industrial property making up the 19 properties. Lettable areas, 163 retail, 232 office, 18,000, making up that 414,000 square meters. The vacancies, we spoke about the 2.2%. I think we remain one of the counters with the lowest vacancy in the market. But that vacancy is sitting pretty much on retail at 3.5%. We'll look later where that is. The office at 1.3% and the industrial with nothing. Portfolio valuation, so the retail makes up about 3.1 billion and the office just shy of 3.8 billion. And the industrial, we'd like to increase our exposure on industrial, but the correct industrial. Our minimum investment criteria, as you know, is 100 million. So It's very hard to find these industrial properties beyond those thresholds, but it's something that we constantly search for. So that direct property translating 7 billion. Value per square meter, also another quite important. I think if you look at 19,000, just shy of 19,000, it's very hard to replace retail for that kind of money at the moment. If you had to build a new big regional shopping center, you'd look at anything between 20 to 23,000. So that's quite conservative valuation of the property. Again, office, 16,000. If you look at the kind of buildings that we have, we just saw that 124 Main right now. To replace that building would be about 30,000 rand a square meter. So again, it talks to, because we have long-term leases with our tenants and that sort of thing. So the tenant strength is there, and the quality of the building is there, well maintained, well looked after. B-grade building, but for just the parking, not to be an A-grade building profile with our buildings. So that translates in total to about 16,800. Cap rates that are utilized, very conservative on the retail. Again, 8% cap rate is very conservative. 8.7 on the office and 10% on the industrial. Property by value. I suppose what's important here is really your office, 116 rand. This is the gross rent per square meter, and we believe that's a sustainable rental. We are exposed to some of the government tenants. So the question is always, do you have market-related rentals? We believe as a gross rental, that is very market-related, more particularly with the kind of grade of buildings that we have. Average escalation, 7.4% in retail. That's market, I think if you look at other counters in retail, very much, this is the enforced escalation on the leases. 8.5% on the office. As you know, we had, that figure looked like an 8%. We'd like it to be around the 8% because one thing you want to guard against generally is your escalations starting to make your rentals too expensive. At renewal, you don't want something that drops back to market because it hurts your earnings. We had the Intwesa portfolio coming in. It was about 9%, and really that's what took that escalation to higher than the average of 8% that we'd like, and we're repricing that. So as a quid pro quo for longer-term leases that we still have about another 5 years to go on those leases, but we'd like to get them longer dated as a quid pro quo, give them a lower escalation at 8% so that we normalize our escalations. So that gives you the average of 8%. Weighted average lease period, a good 3.6 years. So you can see the office is winding down towards expiries. As I said, some of them we are already looking at them at long dating them again. So that would change. But the retail very healthy at call it 4 years average lease profile. Net income, net cost to income. Retail 15.2, that's very decent. Generally, if you benchmark the market, I think we're one of the lowest in the market. Office, 11.1%. As you know, most of our buildings, they're semi-triple net, if you want to call it that. Got a few buildings that are multi-tenanted with higher operating cost ratios. And that's why that's very healthy. The industrial is really a triple net. I think that 2.9% is probably property management and insurance and things like that. So very low. And that gives us the healthy 12.7%, which has come down from, as we alluded in the key highlights. Top 10 properties. We have Hemingway's as our mainstay. It remains the mainstay. We'll talk about performance of Hemingway's. It's delivered a very good, excellent 10.5% performance on turnover growth and that sort of thing. We'll talk about it later. But still a very good asset, growing, a lot of tenant demand. It makes up about 19% of our income. 74,000 square meter GLA. We acquired that property on 17th May 2011. That's when the company was listed. The cost back then was 1.3, 1.6, and that's a cap rate, call it the exit cap rate that Old Mutual has utilized. I think if you look at an asset like this in the market, you will not find it for that cap rate. You'll get the whole market scrambling to bid on that. Sunny Park, as you know, we acquired this property 2 years ago at 571. It's now standing at 623. Again, conservative cap rate. We acquired this at 775 at the time. Salu Building makes up the third largest property. As you know, it's a beautiful tower in Pretoria, and standing at 608 million rand with a cap rate of 8.3, followed by Liberty, The military has been there in that building. It's intelligence of the military. It's been there in that building for the last 30 years. Highly invested in the property. Victoria Mclenge building, and so on and so on. So effectively, these top 10 properties make up 80% of our income. As you know, we only have 9 others. So those 9 others only make up 20% of the income. Top 10 properties also contribute 82% of the value, and Hemingway is 23% by value and 19% by income. Income spread of the top 10 properties. So as we mentioned, Hemingway is making up 21% of the income. That's quite healthy. I think we come from the days when Hemingways used to make up about 36% of that. So, as we grow the portfolio, that comes down. 19% by net income. Victoria Mclenge 11% and 9% by net income, and so on and so on. So the difference is, I think we always get the question, because you expect the rental income to be higher than your net income, right? But if you look at Salu and you look at Blute Street and the others, so what we do, the rental income is really a rental. And your net income will include services like cleaning, security, and that sort of thing. Sectoral spread. By value, the office makes up 54%, and the retail 44%, and GLA 39% retail, 40% by income. Geographic spread. So we're quite spread out in 4 different provinces in the country. But Gauteng, which is the mainstay of the country, we have by value 66% and by income 69%. That's despite our big presence in the Eastern Cape with Hemingways and Mdantsane. By value, that's 29% and 25% by income. So you've seen that whittling away over the years, and Gauteng really taking the lion's share of our portfolio by income and by value. Leasing activity. It doesn't sound like much, but to have expiries of 16,000 is quite a bit for a challenge for a leasing team. So how have we fared against this? So we had on retail about 163,000 square meters. The vacancy was 6,600. As I said, that's the bulk of the vacancy that we had, which represented 4.1% of the vacancy in retail. So how did we do in the 6 months? 163,000 carried over with some GLA adjustment. We now have a better 5,736 vacancy, which now represents only 3.5%, down from the 4.1%. I think that's really, in a nutshell, what retail looks like. So of all the expiries we've had in the 6 months of 16,000, we renewed 14,400. You guys, as you know, within that 6 months, we also had the whole A-bill story. So you had Ellerins, the Bears, Weatherleys, who else wasn't that some mix? Furniture City, and so especially for the township centres, they were big. In Hemingways, we had the Weatherleys and the Furniture City. In Mdantsane, we had all the Ellerins and the Bears stores and that sort of thing. And with that collapse of that business, we were able to replace most of those tenants. In fact, there's very few that's not been replaced. There's very little space left. And that shows you in the healthy net figure that we're looking at the end of the period. There are new lettings on the vacant area of 5,400. So if you look at this picture again, what it tells you is that of that 6,600 vacancy, we made inroads and we filled up 5,400. We literally almost wiped out the vacancy. So the new challenge is really the boxes that Able posed to us on those lease expiries of 16,000, which then translated in renewals of 14,400. And then there was some lease terminations, which also are within the Able stable. Our office side, 251,000 healthy portfolio. That 3,300, as you know, we had that Upper Square COJ consulting division, which we have not been able to replace. It was the consulting division of the COJ. Their contract came to an end. We had some tenders that the team worked on, and they've not been awarded, even though we were pre-selected. But again, we'll talk about, for instance, Ascension coming in later. We've got one of our properties where one of the tenants, Pick It Up, wants to take the entire building. and we have to vacate some of the tenants. So we're able to transfer those tenants. So we're in the course of closing that vacancy because of that. Again, we become the preferred landlord of choice with government because now we have the critical mass and we're able to move the tenants around. So we're able to move that and close that vacancy, and that's going to be happening in the next 6 months. So you literally, we've always said our office is really bulletproof, and that's testimony to that. So you're going to wipe out that vacancy shortly. So the GLA, effectively, 415,000, vacancy of 9,000. That's how we started the period. We end up with 414, with 1,000 square meters net off that we've improved in the 6 months, and 2.2% vacancy at the end of the period. Lease expiry profile. So in the next 12 months, this is outlook for the next 12 months, effectively, from the end of the period. 13% in the retail, 6% in the office. The industrial carries on. So that makes up about 10% overall. Next year, 13% in retail. Again, another 12 months to 2017. 10% in the office, and 12% in total for that. I think where you have the bulk of our office coming up, 54% in 2018, 3 years from now, effectively. We're quite comfortable that those tenants will be renewing. They're pretty much single occupiers of very large buildings that you can never find. And as you can see, our buildings are very, not only large, but they're swanky, they're beautiful, and well-maintained, lift upgrades, air condition upgrades. They're really very happy tenants. We've never had issues of payments and that sort of thing, because tenants don't pay you when they're frustrated sometimes. Overall, lease expiry profile, 9% again, coming up in the retail. I think that's the same picture. If we look more specifically on the retail, Hemingway's 13% coming up in the next 12 months, effectively, and 9% coming up in Mdantsane. We'll look at retail performance later. We're fairly comfortable these tenants will be renewing at positive reversions going forward. 23% on Sunny Park, and Bloot Street at 7%. And likewise, in the next 12 months thereafter. As you know, our centers are fairly new. So if you look at Hemingway's, for instance, and Mdantsane and Bloot Street, they'll be completing 6 years and 5 years and 7 years respectively. So it's the 3 years that were rolled over, and now they're coming back again, and so on. Hemingway's, in particular, for the next 12 months, calendar months, part of that 13% is Truworths, which was a 6-year lease also, which was in that. Trading densities is an exciting picture for us. So if you look at trading densities, Hemingway is showing a very healthy trading density of 26,600. Again, why do we disclose trading densities? It's about profitability of our retailers. Are they profitable? Do they generate good turnover per square meter? Because trading density is really turnover per square meter. Are they profitable? It's a good measure that the retailers use for themselves, so we report these figures. 8.4% up for Hemingway's. Again, relative to the age of maturity for a center of this size, the center is 6 years. If you look at IPD trading densities that they disclose for regional centers, again, Hemingway's is slightly on the cusp of being a super regional, just at the upper end of the regional center. But if you look at regional centers, they stand about 25,000 trading density. But again, that's measuring a 40-year-old. It's a range from a 40-year-old center to, I think they've got about 5-year-olds. So from 5 years to 40 years, that's the average. And this is above that average already, while it's at the bottom end of that maturity cycle. So that's really something quite exciting. If you look at a feasibility for a new center, generally, because we develop also, a feasibility for a new center stands around the 18,000 mark to be profitable, to know that these retailers will always be around. So to have that 26,000 is very, very healthy. Again, in Mdantsane, 10.7% up with the trading density. Sunny Park, slightly down, but very high trading density. And Bloot Street, slightly down, also but again, very high trading density. Turnover growth. This is testimony to the dominance of these centers, again, which we keep re-emphasizing. If you look at retail sales, January was 1.9%. This morning, the retail sales update came up they were 2.4% on February year-on-year. And that's the same period that you're comparing to. So if you look at the center, 10.5% up, very healthy. It's exceptional. Mdantsane, 5.8%. Sunny Park, 6.8%. Very interesting for Sunny Park because it's a 30-year-old center that it could still deliver such growth. Blood Street, as you guys know, we had the impact of the other center on Blood Street, which is across the road, the Cambridge Center, that opened there. And the impact was pretty much on the food, because it had a Cambridge food, on the spa, super spa that we have. However, we monitored that quite closely, and there was another center that opened. As you know, Blood Street, there's a tax in the bus rank underneath, so what we do is we monitor the number of taxis that go to the townships and which townships and that sort of thing. So there was a center which was open, Soshanguve, by Resilient Group, which also impacted because we had about 14% of the taxis going to Soshanguve. So part of that impact was that. But the good thing is that we've now, it was always part of our plan from the asset management perspective to create more dominance in terms of fashion and that sort of thing in that center. So we've expanded that center now. We added the bridge, etc. That dominance is starting to come through because from a negative 0.9, we're now 4.4. I'll call it 5.3 in real terms. So we're starting to see that growth coming through with Blue Street. Again, this is on the back of construction work that was going on there and that sort of thing. So with that vertical integration of the east and the west wing, we're starting to see very good growth because people can walk across and it really is quite a... And we've had very little... on the 12 months that's being reported here, on the 6 months that's being reported, there's only 2 months impact because we opened that bridge in end of December. Rent to sales. Again, why rent to sales is important. Rent to sales tell us the story whether our rentals in the shopping centers are sustainable going forward. Whether when it comes to renewal periods, we're likely to have income drops on our income, or we're going to have positive reversions and better rentals from tenants. So if you look at Hemingway's, it's down 7%. So it's rent to their turnover, effectively. That's very healthy. You want it to come down so that it really gives you a picture of how sustainable that rental is going forward. Now, at 7%, it's very sustainable for a regional center. Generally, I would say the benchmark, if you look at the hyperop counters and the others, is around the 8%, 8 or 7.5%. So at 7%, very sustainable rent to sales going forward. What that picture also tells you is the fact that we're more likely to benefit from turnover rentals going forward from the tenants whose rentals are quite low. So you've got tenants like Woolworths, for instance, who have one base rental at the outset of the lease, and everything else, the rental escalation is determined by the turnover growth that they earn. For instance, in Hemingway's, they've been on a steady 18% growth in their turnover, which means our rental from them effectively is 18%. Mdantsane, again, coming down from 5.6% to 4.5%. I quizzed my team on this. I thought, geez, you've done something wrong. There's no way we could be at 4.5%. So we drilled down, why is that low? 50% of your tenants there is groceries, and groceries have a very low rent-to-sales ratio. So as against other normal shopping centers where we've got critical mass of fashion, etc., township centers generally, people in the townships, 40% of their spend or retail spend is food, basic food, because basic needs for them are more important than somebody living in the suburbs. So that's why we have a critical mass of food there. So we've got 2 big food anchors. Plus also we've got hardware, cash build, we've got furniture, a lot of furniture as well. So all those categories making up 50% of that center are on very low rent to sales because their margins are very small. And that's why we've got a very low figure there. Again, we have very good trade coming through from those tenants in that center in those categories. If I mention just by way of example, Pick n Pay, 45,000 trading density, ShopRite in that center, 3,000 trading density and that sort of thing. So we're starting to see the upside of turnover rental that will come through. And that's really what underpins the numbers that we're revising even going forward. Very good property fundamentals coming through. Sunny Park, from 7.2 to 6.6. Again, very sustainable going forward. Blood Street, 6.4 to 5.8. Very, very sustainable. Blood Street, very similar in profile of people to Mdantsane. Spend per head, Hemingway's up 158 Rand per shopper that they spend in the center. Very decent. If you look at, I think the only reported figures that you can benchmark with is the Hyperop figures for Hemingway's in particular, the type of shopping center, very healthy. We're seeing a lot of high-end customer visiting the shopping center. Some of the highest trading densities are, for instance, in jewelers like Browns, et cetera, in the shopping. Discam, trading 120,000 trading densities and 150,000 trading densities for Browns and those sort of things. So very high-end customer. One of the things, for instance, with Hemingway's, there's a G-Star that Foschini Group opened there about October last year. And within 3 months, it became the highest turnover G-Star in the country, surpassing Gateway, because before that, Gateway was the highest. So we're seeing the high-end customer, both from a young age, young adults, right through to old age, in terms of jewelry and that sort of thing, coming through that center, which is quite important for us. And that's represented by this very good spend per head for us. Mdantsane, 62, very decent for the township. Again, Mdantsane, the reason why that's dropped from 68 to 62 is we've seen increase in foot traffic in that center. Foot traffic has increased. I think the figures the last quarter was 7.5%, and in the year to date was, sorry, Nigel? 13. Yeah. So a high footfall coming through that center. Obviously, it impacts your spend per head. The more footfall, the lower the spend per head. So very healthy in that center. Why are we having such, footfall coming through suddenly? As you know, we opened SASSA, so pension payouts and that sort of thing, offices. One of the able boxes, for instance, Bears, they took that box because they're all on the outside. And it's always been our plan to put those kind of, because all those people would naturally just go through the shopping center. We have times when they, on pension payouts, we have to close the doors of the mall because the mall is just too full. So it's a very rare phenomena. But we've seen that through. Again, we've also opened offices for the City Council, the BCM, in the shopping center. And people now can go pay rates at the shopping center, get their electricity at the shopping center, and so on and so on. And those people will find their way into spending their money into the shopping center. So that we're seeing quite good performance there from that perspective. Sunny Park, 45 Rand. Again, we'll keep making the point about Sunny Park, that Sunny Park has got the day customer who comes just for lunch to buy a meat pie, for instance, and go. So it's a very distorted number. You can't benchmark it. Blood Street, we don't have food counters, again, because we have very high volumes of traffic because we've got the bus and the taxi rank underneath. They're not necessarily your shoppers, but you do hope that you'll pick up one or two as they go past the shops. It'll be a very distorted picture, in other words, because you won't be able to benchmark it. Fund management. So as you know, we've had some corporate action. We announced our intention to continue to acquire 100% of the Ascension A units. You guys would recall that we started this journey about 15 months from now. It was December 2013, where we embarked on a takeover of Ascension and a friendly takeover. And the first step to that was the Menco acquisition of Ascension, which was mired with competition. And we then acquired the vendors, Shanrai's units together with his consortia. And then there was possibilities of merger, and when that was not successful, we then reached a very good amicable settlement with Delta, where we acquired their 16% as well, which then gave us the 32%. We then had issues with JSE on the A units, as you guys all know. JSE doesn't want those units to continue in the market. They see them as debt instruments. We had to resolve that, and that delayed us. So we resolved that last year by December, and hence we were able to proceed. So we've now announced our intentions. We've issued circulars. We will continue to be the largest blacklisted REIT in the market. Post-acquisition portfolio will have 47 direct properties with Ascension. Post-transaction value, 14 billion rand. That's the next 6 months. I think if you look at the results that we're announcing today, we're saying we're just shy of 8 billion with the 32% in direct property. As you know, we've since, I'm now going to talk about New Frontier just after this. With the New Frontier, currently we stand at about 11 billion. Because New Frontier is, with the 62%, we are controlling shareholder, it gets treated as a subsidiary. Hence, you consolidate all its numbers into Rebosis, and it gives you an asset base of 11 billion. So post-Ascension, we moved to 14 billion. So the 6 months post-28th February is significant in our lives, because we moved from an 8 billion to 14 billion, assuming the transaction of Ascension is successful. Post-transaction market cap, around 8 billion, more closer to 9 billion than 8 billion. But that's how we're looking. We're well positioned to serve government tenants in our office portfolio. I mentioned the one point about pick it up on Upper Square, where we're able to fill vacancies across the sector now, because we've got the critical mass, and we know what the tenants want to do, and we can move tenants around, which is quite significant in our lives. Corporate action, Ascension measure. So we've just given you the timetable here. Just, there's a lot of circulars that's been issued, et cetera, but these are the key dates that perhaps you can note. 24th of February, we announced our intention. 31st of March, we issued a circular on the conversion, what that would look like. 22nd of April, we will be issuing share scheme circular. 30th of April, we'll be issuing the conversion voting circular. 22nd of May is a voting day. And hopefully by 30th of June, we consummate the transaction. New Frontier. New Frontier is exciting for us. Exposure for us to hard currency in terms of exposure to hard currency of a growing economy in the G8, one of the fastest growing economies. So if you look, we acquired 62% of New Frontier for 1.18 billion. As I said, that 1.18 billion was 30% geared. We had 820 million rand cash in hand, which we utilized, and we borrowed the balance, which is the 30%. Our board was quite, initially as management team, we thought 20-25% of New Frontier would be the right level. Our board was very emphatic that they want control of New Frontier. They saw this as the future, and they were of the firm view that in diversifying and looking at offshore markets, this is the best market. The board actually had a strategy session at the start of the year where they looked at the key metrics of a number that comprise a number of things. One of them, ease of doing business, language, infrastructure, enforceability of laws, or judicial enforcement of contracts, et cetera, a whole range of key metrics that they looked at. And then they put the various countries, and the UK came right at the top. So it was no coincidence that perhaps the board had overwhelming support for a transaction in the UK. It's because of that. One of the key components of that was growth. You don't want to be in Europe at the moment, I think. But in the UK, you have 2.7% growth in that market. And the only other first world market is the US, but US is a very difficult market. So UK, New Frontier, two dominant retail centers in the UK, Burton-upon-Trent and in Middlesbrough. Total GLA of the centers, 74,000. They're about 40,000 square meters each. Weighted average unexpired term of about 10 years, which is quite important. Our retail here is about 3.6, and generally retail here is much lesser than this. So this is quite important aspect. Again, these are tenants who've been in these centers. This center is about 30, 40 years old. Although they've been upgraded, they look new, but they've been around for a long time with the same tenants, trading well continuously. Year-on-year growth in the UK, retail sales. About 2 weeks ago, this figure came out, 5.7%, very decent, against what we see in South Africa of 2.4%, on the back of an inflation figure of 5.6%. So you're in negative territory in real terms in South Africa. Whereas this, 5.7%, on the back of an inflation figure of 0.3% in the UK, in real terms, you had 5.4% sales growth, which is quite important. There's another figure that just came in this morning from the UK stats that says they've seen 4% footfall growth into retail centres in the UK. So all these positive figures just coming through in the UK just cements the case for New Frontier for us. Strong national tenants, Marks & Spencer, big international group, which is UK-based. New Look also, similarly. Boots Pharmacies, big pharmaceutical group. Topshop, also in South Africa now. WH Smith's, the bookshops. H&M, fashion, international retailer with UK as their home. BHS, etc., etc. A lot of other tenants like River Island, a whole range of other tenants that are not listed here that are in these centres. These tenants make up about 90% of the income of these centres. For us, that's very important. If 90% of your income comes from national tenants, it really, the profile of these centres is, and remember these tenants have been there from time immemorial for the last 30 years, and they continue to trade very well, continue to renew their leases, continue to generate good profits for their companies in these shopping centres. Close proximity to major transportation nodes and located on the high street. This is very important. Location on the high street for us is very important. High streets in the UK, that's where retail happens because of the public transportation. There's train stations there, buses, taxis, and that sort of thing. We said we're not going to invest in centres out of town, deliberately so as a strategy. And I think you've seen through other counters who own centres out of town what's happened to rent reversions and that sort of thing. If you take passing rentals, the ERVs, if I use the terminology they use. So we invested in those centres. These centres are in the high streets in those towns. They're dominant in those towns. In Burton, the next largest centre is only 16,000 square meters. In Middlesbrough is about 23,000 square meters. There's also a green zone policy within those cities that says no other shopping centre will be allowed out of town. So you have protection. So these are the things that we look for. We've got the retail experience. We use that retail experience to the best of our knowledge. Over and above that, we have a very highly competent team in the UK led by Mike Riley and the FD, Vicky Whitehouse. They've, Mike, CEO of a REIT, head of property finance. He's seen all these, funded most of the big retail centres in the UK in his life. And, so we took from the top drawer a team that really knows what they're doing and understand that market very well to complement our skills in the UK. They're the asset managers to this, as you guys know. Over 180 tenants in both centres. Combined annual footfall, 21 million people through these centres. Again, it's testimony to the high number of people in the high streets. Some of the shops in these shopping centres face the high street, and then they connect into the shopping centres. very high number of people. Remember, these are 40,000 square meter centers. Growth, as I've mentioned, this is the forward yield we bought this at. So whatever fees, whatever has been incurred by New Frontier is net of this. Our investment as Rebosis is on a 7% forward yield. Again, these economies have virtually no inflation, hence you don't get escalations in rentals. However, these centers are at 3.7%, have a 3.7% income growth year 2 on year 1, which is quite important for us going forward. Again, one other point that I need to mention is the fact that the budgets that underpin the income going forward for these centers, it is 8% below the current passing rental of those shopping centers. So it's what we call ERVs, economic rent reviews. But those ERVs in the UK, unlike us with rent to sales ratios and that sort of thing, they look at, they appoint surveyors, the tenant appoints a surveyor, and you appoint your own surveyor to come and determine what's market-related rental, because rentals are determined by various factors, zoning of the of each box and that sort of thing, but also what was settled around for a similar size box in a similar size center or area. So it's quite a lengthy process. So with all the leases that come up for review and that sort of thing, we are 8% below the passing rentals. That just shows you how conservative that has been budgeted going forward. Budgeted, the leasing agents here, Hans and Mitchell, they manage about 60 shopping centers, regional shopping centers across the UK. So they understand this market and they understand what ERV going forward is about. Very conservative estimations here. So we're very proud of this investment going forward. It is not dilutive in Rebosis' hands. It is neutral, slightly enhancing in our hands. And that's what also underpins our numbers going forward. New Frontier continued. Access to offshore retail property exposure in a stable and growing economy. Exposure to attractive pound investment and returns. Attractive yields at low lending rates. All-in costs at 3.6. Our budgets were at 3.8, and the rates have since come down. So by the time these were fully fixed, which happened on the 14th, which is 2 days ago, the debt was fixed at all-in 5-year fix at 3.6% in the UK. That's 5-year money, effectively. 80% of the debt is fixed. And that debt is 60% in New Frontier. Again, because of the low lending rates, on an interest cover perspective, is 3.2 times interest cover, even though the gearing is 60%. So you weigh that generally. So in our markets, 60% would look high. But on an interest cover perspective, that 3.2 times in our market probably equates 30% of the gearing in our market. Robust high-grade retail acquisition pipeline. I think we've spoken through the characteristics of this. Insofar as the pipeline in the UK, New Frontier is looking at really exciting pipeline. There are about 5 good shopping centres who share similar characteristics as these centres in the UK currently. Again, talks to the quality of the team that we have in the UK and the team that runs New Frontier from the London office. Attractive growth through yield-enhancing acquisitions. All future acquisitions, unlike the initial acquisitions or what makes up the company, which will have to absorb, asset management fees and corporate costs like directors' fees, a whole range of things. These future acquisitions don't have to do that. So they come straight into, and they're enhancing. So even if you buy a property for 6.5%, you get it 8.5 or 9% effective yield, cash on cash. And that's really what we're looking at here. Very attractive for us going forward. So even though we bought at 7% forward, that 7% with the enhancement that we're looking at, perhaps by year end, you're looking at about 8.5. And that's really what we're talking about. Similar characteristics, 90% tenant, national tenant profile, long dated, long average, weighted average lease profile, et cetera, et cetera. What does New Frontier make up as exposure for Rebosis? 14% currently. Again, I made the point that upon assumption of the scheme of arrangement of ascension, that 14% comes down to 9%. Very decent, very healthy for Rebosis. These are the factors that the board looked at. Prospects. Underlying portfolio remained very stable under tough economic climate. Again, retail sales low. In real terms, retail sales in a negative territory. And yet our centres delivering a very healthy 10.5% in Hemingway's as mainstay. Exposure to hard currency and UK retail property market for all the reasons we've mentioned. Assets under management potentially exceeding 14 billion by year end. Full integration and management of Ascension property portfolio by year end, again, as per the timetable that we looked at. So these are very good prospects for us. Assets going up, post year end, New Frontier, post year end, assumption of Ascension, assets moving up to 14 billion. Again, what's exciting in our lives is the imminent implementation of the DMTN program that will reduce our cost of debt. Very important in our lives. So our average cost of debt currently is about 8%. But going forward, that picture is going to change. Again, doing that whilst achieving a longer dated debt profile that we'd like to increase. Conclusion. Again, just to recap, 8.2% year on year, ahead of the upper band of the focus range. We gave you 6 to 8% growth focus range. We're ahead of that. Solid corporate fundamentals. Again, no corporate activity, no acquisitions, no enhancement from anything else. Rental, guaranteed rental from our leases that we receive from the tenants. Underpin that distribution growth. Efficient cost management. Again, thanks to the team. They've done a good job in bringing down the, notwithstanding the pressures that we have in terms of salary increases, in terms of a whole range of inflationary issues that are coming through. That cost containment, very important. Our costs are down, and that underpins that distribution growth. Asset management underpin the income growth as well for the redevelopments that we've done, the income coming through from those redevelopments. Again, going forward, we see that, because this is repeatable income going forward, we see that picture continuing down the line. Excellent strategic focus and execution in growing the fund. Again, to be able to turn the kind of opportunities that we turn takes a great team. And I think the kind of focus that we've done and the execution, again, let me just talk very briefly. So the strategic focus, we said Ascension. We had some delays. We are consummating since Ascension. That's going ahead. And we've had a lot of support. And come 22nd of May, we're very hopeful that goes ahead. The execution, if you look, for instance, we've made investment in New Frontier now. We said to market, a lot of our investors invested directly in New Frontier. And the timetable for New Frontier was deal closure, 30th of April. It happened on that day, 8 o'clock at night, not one day late. And we said transfer of the properties 14th of April. It happened exactly on the 14th of April. That's the efficiency at which things get executed. And we continue to grow the fund. Focus range is being revised from 6.8 to 8 to 10% on the back of strong fundamentals. Ladies and gentlemen, thank you very much. I want to thank the management team, without which we wouldn't be able to deliver these results. Also want to thank the board. Our chairman is here, for the continued support and the wise counsel and leadership that you guys display. We have a very robust and strong board that really supports us as a company. Thank you. I know normally we have questions, but we're going to have one-on-one after this. So we're all available. My team is all available after the session. We are pressed for time. The team is available for questions, and we can interact after the session. Thank you very much.